Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a real estate expert, a successful real estate investor. He sells turnkey cash flow positive rental properties. He teaches real estate investing for years now and has made a lot of podcast episodes for years as well about real estate investing and the economy with different shows, including his Creating Wealth show. So Jason Hartman, thank you for joining me again.
Hey, Jason, it's good to see you, or good to talk to you, I should say. And I hope the listeners don't get too mixed up because they got two Jasons here.
Well, I probably won't forget your name, so yeah. I'm good to go there.
That's for sure. That's for sure. You got it.
So, Jason, I want to ask you first about a housing shortage in the U.S. So when I hear people talk about real estate and mortgages and rents going up, one of the first things I hear people talk about is this housing shortage, but I don't hear people go into a lot of details about it. So how large is the housing shortage here in the United States?
You know, there are different opinions on this, and there's one guy on YouTube who tries to debunk the housing shortage ideology, but I really think he's wrong, and he makes some big leaps in logic. You might know who I'm talking about, and I've got him scheduled to come on my show, so I can't wait to grill him with some questions on this. But there still is a very significant housing shortage. It's far more acute in the entry-level housing segment. That is very, very undersupplied. The market is changing a bit. These higher interest rates have definitely put the brakes on the market. We're seeing some signs of inventory increase, and I've got specific numbers to share with you on that. But just overall, kind of the macro picture is still a very significant housing shortage. Inventory increasing a bit, but we still have, Jason, a long, long way to go to get to even normal inventory levels in terms of properties for sale, much less what would be considered a down market or a buyer's market. We are far, far away from that. And I can share some specific stats with you on that as well.
So you think the Federal Reserve then, since the 2008 financial crisis, manipulating interest rates down, that has caused real estate investors or people who are not necessarily real estate investors in the past, they couldn't park their savings, their retirement savings in US Treasuries for a 5 or 6% guaranteed or quote unquote risk-free return and live off the interest payments on that. So instead, they were going to people like you and they were looking to buy rental properties for income instead.
Yeah, it's I mean, the central planners have really just distorted the market in ways that are just ridiculous. I mean, it's just ridiculous what they've done. In this more recent scenario, they waited way too long to raise rates and then raise them too suddenly all at once. And that has just put the mortgage market into disarray. But this policy is just overall way too accommodative. We should not have artificially low interest rates. They should not be centrally planned. The market should determine the cost of money, not a central bank. But we have what we have, so all we can do is talk about how best to act within what we have, right?
And we're recording this interview on Friday, June 3rd, 2022. The 30-year interest rate on a 30-year mortgage, the interest rate on a 30-year mortgage is now above 5%, I think, average. You can correct me if I'm wrong. So how much has it gone up in just the last 6 to 8 months then?
Well, I mean, it's almost double what it was. And it depends if you're talking about owner-occupied rates or non-owner occupied rates. And then of course it depends if you're talking about, jumbo rates or conforming loan limits, FHA, VA, whatever, it varies a bit, right? But it's almost double. So it's very significant. However, I really want to stress this idea, Jason, and that is compared to what? You hear me say that on my show all the time. It's, my common phrase. What we had was such an anomaly. We literally had the lowest interest rates in 5,000 years. And yes, and you're probably familiar with the late David Graeber. He wrote a great book called Debt, the First 5,000 Years. There are actually studies of interest rates going back 5,000 years, if you can believe that. So these rates were absurdly low in response to COVID. And, that's just not a valid point with which to compare because it was so abnormal.
In certain markets, like here in the DC metro area, some of the borrowing was above 5%, but anyone who needed a mortgage was penalized compared to these all cash bidders. And you were talking about this before we started recording. We've discussed this now for the last couple of months, just some crazy stories. I'm not a real estate agent, but my best friend is. So every week I ask him for how the local real estate market is doing. And I was just hearing these absolute crazy stories about bidding wars, all cash bidding wars. People were, properties would close in under 10 days. There would be 30 all cash bids driving up prices between 100,000, depending on the property, and 400,000 over the asking price. So do you think then that these all cash bidding wars, are these going to end anytime soon?
Well, they are slowing, no question about it. And we're not seeing as many offers on properties anymore. The search volume has decreased. The inventory has increased slightly. But the direction it's going in is we're probably going to see even more inventory on the market overall. And so that lessens these multiple offer situations. It lessens the bidding wars, and it hopefully puts back into place a more normal market where buyers can have adequate protection when they buy a property. They're not waiving appraisals. They're not waiving inspections, that are really prudent things to do that are meant to protect buyers from getting into bad deals, right? And so we're seeing less of it. The data on this stuff is pretty lumpy, if you will. So I can't give you like actual numbers. I can certainly give you numbers on inventory though, and that should give some insight into that. So can I share those?
Yeah, sure.
Okay, great. Well, we started off the year with the lowest inventory ever, quite literally. Just about 293,000 homes for sale in the country. And I do want to say, Jason, that when you hear these inventory numbers, it depends which survey you're using. I'm using Altos, but a lot of people hear them from NAR, or National Association of Realtors, and they calculate it very differently. What they do is they count for sale properties, they count pending sales, and contingent sales. So their numbers make the inventory levels look much higher. But if you're comparing their numbers today to their numbers a year ago or 5 years ago, then that's okay. At least you're using the same metrics and you're comparing apples to apples. I don't really like the way they do it that much. So I use my favorite source, and that just shows you the number of homes for sale in the MLS nationwide, properties you could actually buy today. So we started off the year with 293,000. And then at the end of the first quarter, we started to see, a little bit of changes in the market, and people thought inventory would increase. But believe it or not, it actually went the other way. It went down by about 50,000 units to 241,000, which was the lowest inventory ever. Okay. But what is it doing now, since we've really started to see the effect of these rate increases? Right now, well, as of about a week ago, we're at about 344,000 units for sale. So about 100,000 more than the lowest point at the end of the first quarter, and about 60,000 more, 50,000 more than at the beginning of the year. But the real question is, what do we need in terms of inventory? What's the comparison that we need to make? Most experts will tell you, and they disagree on this, so it's a fairly wide range, but you still get a sense of it, that we need 900,000 to 1.5 million homes for sale to have a quote-unquote normal market. That's normal. That's not a bad market. It's just a normal market, a stable market it's equilibrium. So if you think of it like this, Jason, if you walked into the grocery store, and by the way, this might be the future, unfortunately, which is another discussion on food shortages, of course, and inflation. But If you walked into the grocery store and you saw that somewhere between 75 to 80%, or at least 66% of the shelves were empty, that's what the real estate market looks like today, even with the higher interest rates.
And if the shelves were empty, that could also cause, and I know real estate is more expensive than going to the grocery store and just buying some food and stockpiling that, but that could also cause, if you're a more affluent person and you have a lot of extra cash, that could also cause more stockpiling, faster buying from some parties.
Absolutely. And it could cause hoarding, just like we've saw with the gas lines in the 70s, or various food shortage problems over the years, many times throughout history. Yeah. You're right.
So here's an important question as a libertarian, someone who supports capitalism and the free market, Jason. How can all of this be fixed if politicians and bureaucrats and regulators were not blocking the free market from solving this problem?
Yeah, supply side economics is the answer. We have simply got to increase the supply of housing in this country. Period. Full stop. End of discussion. So then the next thing is, well, how do we do that? Right? Well, maybe there will be some technological breakthrough, right? Maybe there will be some disruptive technology where we could all live in a force field instead of a house built of sticks and bricks, right? Very unlikely. I'm just kind of kidding when I say that. Maybe we have got to remove the stigma in this country from manufactured housing. I mean, Jason, look, it's really much more efficient to build houses in a factory. That's the way houses should be built. There's a lot less waste. It's far more efficient. I mean, Henry Ford invented the assembly line, and it revolutionized the world, of course, right? Why aren't we building houses on assembly lines? That's how we should build houses. Even the components, even if you want to build a big mansion, why isn't everything just manufactured in a factory and trucked to the location for assembly? That's the way housing should be done, but it's just not, because we have this stigma. And it's not only a buyer stigma against manufactured housing, it's also a bank and lender stigma against it. You just can't get the same type of financing you can on a traditional stick-built home. I interviewed someone on my show last year, and he said something to me that I thought was really kind of summed it up nicely. He said, the biggest innovation, the biggest technological breakthrough in construction in the last 100 years was the nail gun. And, he's kind of being sarcastic, but that's not all wrong. It's just a very primitive industry. And to make matters worse, we've got these lefty environmental movement people who want to restrict building even further. I mean, there's an old riddle, right? What do you call a developer? Someone who wants to build a house in the woods or at the beach. What do you call an environmentalist? Someone who already has a house in the woods or at the beach. And it's just total hypocrisy, right? And all they're doing is just limiting the supply of housing and impoverishing people, forcing them to be homeless. It's just wrong. It's so unfair. We've got to reduce the restrictions, make it easier for builders to build. Maybe every house doesn't need to have impact glass and carbon monoxide detectors and all of these crazy construction specs. And I know people are going to yell at me and say, Jason, that's so wrong. I mean, people could die. Well, of course, that's life. Yes, I know. I mean, look, houses that don't have sprinklers have more of a fire hazard. Not every house has sprinklers. What are you going to do about that? Look, folks, this is just simple economics. It's better than living in your car. It's better than living in a refrigerator box on the streets. Okay, we've got to make it easier to build houses, and there are many ways we can do that.
Well, you have robotics, but for new technology, I mean, there's 3D printers large enough that can 3D print a basic house with basic materials now. Well, I've seen them in the lab.
You're right, and I have gone deep down that rabbit hole. In fact, about a year and a half ago, I was very seriously looking into starting a 3D printing construction company. And we were interviewing all of the manufacturers of those printers. I hired a consultant to help because I thought, I want to end the housing shortage. But guess what? The reality is, the stuff you see on social media about 3D printing is just hype. It's just such a big lie. In Austin, Texas, there's a project where they've got these 3D printed houses. And the promoters say these houses are only $10,000 each. But what they don't tell you is that that's just a shell of a tiny little house. It doesn't include HVAC, air conditioning, heating. It doesn't include plumbing. It doesn't include electrical wiring. It doesn't include land. It doesn't include permits, code, zoning, cabinets, faucets, hinges on doors. It's a shell. That's all it is, right? So the 3D printing thing has been so massively overhyped. It takes a lot of material, and concrete is very expensive, which is pretty much what they're built of. So, some have some composite materials and so forth, or concrete hybrids, but it's just not there yet. I hope it gets there. I hope there is some disruptive technology, but we've got to make homes in factories, and the government has got to get out of the way and make it easier for builders to build homes. It's the only solution.
So if our listeners are not familiar, both you and I are from California. Both of us grew up in California. I think you left the state too. I left it 20 years ago.
Yep.
I think it's the politicians, the bureaucrats, the regulators in California that are preventing the builders from building affordable single-family homes, more affordable apartment buildings where people can actually afford the rent. Yeah. And it seems that like a lot of this capital for the builders in these major metro areas, whether it's California or elsewhere, it's going into luxury condos. It's going into higher end single family homes. And the people who are looking for a starter home, young adults who are either transitioning from rent to a first home, we're being priced out of the market, and then our rent prices are just massively increasing in the last 2 years.
Yeah, it's really terrible. You mentioned California, and that's the worst example of all of these things I am grousing about. But it's true everywhere to one degree or another. California is one of the worst. New York's one of the worst. Yeah, the same thing is happening to one degree or another everywhere. So it's very problematic, and it's just not profitable for builders to build entry-level housing. So they don't build it. One millennial staffer that works for me, he said, he listens to the podcast, and he says, if they know that all of these millennials, 80 million millennials want to buy houses, why don't they just build more affordable houses? And I said, well, let me teach you about economics. There's no money in it for them, so they're not going to build it. Another thing the government could do, if they had any brains, is they could, instead of incentivizing buyers with, ridiculously low interest rates, and all that does is make the price go up, right? Mm-hmm. What they could do is incentivize builders to create more supply. Like, I don't like any of this government interference, but if I'm going to pick, let's incentivize more supply. That's the problem.
So you have to think of this from the government's perspective, and what the government cares about is higher asset prices and taxing those asset prices. So if the cost of capital, if interest rates are cheap, so if a developer can borrow for fairly cheap with artificially cheap interest rates, buy a piece of property in a metro area, buy an old house that was built in the 40s, 50s, 60s, or 70s or 80s, tear that sucker down, the land's valuable, and then build a McMansion on it and sell it for between $1.5 and $2 million here in the DC metro area. And they paid $800,000 or $900,000 for the land and a tear down. That's a big win for them compared to building some of those cheaper, more affordable homes that you and I were just talking about.
Yeah, you're absolutely right.
So again, this is the problem with the government is incentivizing these developers then to borrow cheap and then tear it down and build a more expensive house. And then people in my age demographic or younger, young adults, are being priced out of entry-level starter homes.
Jason, I remember, and there's such a personal example of exactly what you're saying. And this happened to a large degree in the 90s. I lived in a place called Corona del Mar, California. This is a Newport Beach
Oh, yes,
area.
nice.
Yeah, it's a really nice, quaint little neighborhood. Very expensive, has always been expensive, and back then, you had a lot of little beach cottages that were older. Okay, and the typical arrangement you would get is you'd get young people that lived there. There'd be like two or three young people that would rent a house together, and they'd be roommates. And it made it a really nice demographic in the area, fun area to live in, and so forth, right? But then they changed the zoning rules and they made it easier for developers to split the lots. So they could tear down the little beach cottage and build two luxury condos on that lot. And this happened like crazy, and all of the young people got kicked out because all of those houses turned into construction, and they built two high-end condos, which was more profitable, and just got rid of the little beach house. And that's a metaphor for what's going on in terms of what we're talking about,
And those condos or houses are selling for $5 million or more now. So they've gone from maybe a couple $100,000 decades ago. Now they're upwards of many millions of dollars.
Yeah, it's crazy. Yeah.
So I want to ask you now about rent prices increasing. According to Zillow, and I think these numbers are low, national rents are up 20%. Rent.com has them higher than that. Does this mean that more adult children will be moving back home to live with their parents?
Well, that's hard to tell. I mean, the good side of all of this, the tailwind we've got going for us here is the labor market is just booming. It's still very tight. Lots of jobs available. There is some change in that. We're starting to see, hiring freezes and so forth at big tech companies. But overall, I mean, the bargaining power has shifted to the employee away from the employer. And so there's a lot more bargaining power, and they can command higher salaries. And so that's good news. But we'll see. I don't know yet. It's just too early to tell.
So if rents keep increasing, though, I mean, the consumer at some point, with all this inflation, food and energy costs going up, healthcare insurance costs going up, the consumer, especially people whose incomes are not rising. I think the official jobs numbers today said that wages were up 5%. For the average person, wages are not up 5%. Now, there's some people who are growing their incomes, who are beating stagflate tax lie. They're creating a side business, a side hustle. Maybe they own their own business and things are going well online. But for the average American who has a regular job, maybe you got one wage increase, but it's not offsetting a lot of the inflation. So do you think at some point, if rents keep rising, is that going to decrease demand for rents then?
Well, no, I don't think that. I think it will simply cause people, force people to accept less. That's what happens with inflation. The wages will not keep up with inflation, but at least there's some compensation in what I just mentioned, right?
So
but people will simply accept less. They just take less. They can't have
space?
what they want.
You mean they'll have less space to rent then? So they'll have to have more roommates, or they'll have to go from a 1 or 2 bedroom place to a studio, or have multiple roommates or something like that?
Exactly. They will live in a smaller place. They will live in an inferior area. They will simply accept less. They just have to compromise. They have to capitulate. They're just going to get less. That's what inflation does. It lowers the standard of living. It's very unfair.
Well, also, if rent is going up, healthcare insurance costs, healthcare is going up, food and energy prices, gasoline, all those things are going up. That means the consumer, unless they're growing their income, they're going to have less discretionary income too. That's going to hurt those discretionary businesses.
Yeah, absolutely.
So,
it is. Yeah, it is. Absolutely. You're absolutely right.
So I want to ask you now about your index that you created. Could you tell my listeners about that?
Sure. I've been very unimpressed with the different metrics out there that's available to people to understand the value of real estate and as such, understand where it's going, if it's likely to go up, down, or stay the same based on various economic data available to us. I think one of the better indices is the National Association of Realtors Housing Affordability Index, but it has huge flaws and blind spots because it does not account for people that live in an area who are buying and selling, but largely trading equity. And it also doesn't account for FDI, foreign direct investment. When you see a lot of foreign money come into a real estate market, it's totally blind to that. So it's not good. So I developed an index called the Hartman Comparison Index, the HCI, the Hartman Comparison Index. And what it does is it basically asks the question, what is your measuring stick? What are you measuring against? Why is it, Jason, that when people think about real estate prices, they only compare housing to one thing, the US dollar? Why would we do that? The dollar is a moving target. We all know that. We all understand inflation and how it diminishes the value of the dollar. So why would we only be comparing to one thing? So what I do is I compare to a whole variety of things. There's over 40 items in the index now. And for example, the first one in the index, even though I must make the disclaimer, I am not a gold bug. Okay, I'm not that impressed with gold as an asset class, but I think it is a good measuring stick because it's been considered money for thousands of years. And as, of course, you and your audience know, up until August 15th of 1971, we were on a gold standard. Then Nixon took us off of that. So if we let gold prices float for a couple of quarters, and we look at the gold price at the end of Q2 1972, it was $65 an ounce. It almost doubled from when Nixon took us off the gold standard. And the median price house then was almost $27,000. This is the second quarter of 1972. So what does that mean? It means if you wanted to buy the median price house in gold, you would have had to come up with 412 ounces of gold to buy the median price house. In 1980, 8 years later, gold went up by almost 10x, and the median house price went up by about 3x. Okay, well, not quite 3x, almost 3x, about 2.5 times. So the median price house 8 years later was $63,000. Gold was $653 an ounce. And it would only cost 97 ounces of gold to buy the median price house. So that was a bit of an anomaly because there was a big jump there in the 70s, as we all know. But through the decades, 1990, 228 ounces of gold to buy the median price house. In 2000, 22 years ago, 520 ounces of gold to buy the median price house. 2010, 158 ounces. Today, 184 ounces. So we have to ask ourselves, priced in gold, is it cheap or is it expensive? And the answer is, historically, it's actually pretty cheap. Now, you can do this in all the other commodities in the Hartman Comparison Index. The next one I use that you'll probably love because we just talked about it is oil. In 1970, oil was $4 a barrel. It would take 6,400 barrels of oil to buy a house in 1970. Today, it only takes 3,300 barrels of oil. Now, that's not the cheapest it's ever been. In 2010, it only took 1,900 barrels. But in 2020, it took 6,600 barrels. So it moves around. But overall, over the last 52 years, priced in oil, housing is actually relatively cheap. And we can price it in rice, orange juice, haircuts, shares of the S&P 500, whatever you want, median income, copper, Dr. Copper as it's called. And you find that housing is really not nearly as expensive as people think. And here's one more thing to understand about why this is so important. You know, currencies like the dollar, the yen, the euro, the peso, the Brazilian real, whatever, right? They're all moving targets. They're all fiat money. But commodities like oil, gold, rice, orange juice, all these other things in the index, they have intrinsic value. They're traded globally. They're needed by everybody. And it doesn't matter what their relative currency is pricing them in. They have an intrinsic value. And that's the way I think we need to look at things if we want to really understand the value of anything. And then we not only adjust for the house price, but in part 2 of the index, the HCI adjusts for the mortgage payment on the house. And when you do that, even with the currently higher interest rates than they were, over the past couple of years, housing is actually pretty cheap. I know that may sound amazing and people may not believe me, but it's true.
Well, when you're not looking at it in fiat currencies, because whether it's the dollar, the yen, the euro, all these fiat currencies, all these governments, all these central banks, they're all trying to devalue their currencies. They're all trying to do stagflate, tax, lie. It seems that when I hear these politicians at the highest levels of the government, the finance ministers, the central bankers, they all wanted for years until recently, now that inflation is out of the bag and so many more people are waking up to it, they wanted more inflation. They said there wasn't enough. Yep. They wanted to inflate asset prices. They wanted to tax people on stocks, bonds, real estate, all these asset prices going up.
Yeah. Inflation is the best business plan for governments, especially governments in debt, and most especially governments like the United States, the world's largest economy, that happens to be the reserve currency of the world. It is far and away the business plan they want to follow. And you know what? As much as we can complain about this philosophically, and I'm going to agree 100% on that, the fact is, the old saying is never bet against the Fed. We want to align our interest with these two most powerful forces that the human race has ever known: governments and central banks. And we want to benefit from it. What we're really doing is gaming the system. We're playing the same game they are playing. We can learn something from them. There's a reason they're playing the inflation game, and that's because it makes sense for them. And we can use that to our own benefit as well.
Well, what I think the average person who's listening to this doesn't understand is how much in tax revenues the U.S. federal government, the state and local governments make off, whether it's property taxes at the state and local government level. So if those teardowns that we were discussing earlier on an $800,000 or $900,000 piece of land and a $1.5 million or $2 million McMansion is built, that's a lot of new property tax revenue. And then all the houses around that, the property taxes then adjusted to the houses around that and raised too. So that's property taxes. And then on top of that, and you could talk about this as we wrap up the interview, Jason, you have these politicians like Joe Biden and others discussing getting rid of the 1031 tax exchange because they want to tax every single real estate transaction. That means more capital gains tax revenues for the government from real estate as well.
Yeah, no, you're absolutely right. The IRS does not calculate inflation correctly. And one of the other parts that you didn't mention is that what happens is inflation, they don't have to raise taxes in quotes, because they can simply inflate the currency and it'll push people into higher tax brackets, right? The CPI the Consumer Price Index is an epic scam, and it is a way for governments to tax people. It is definitely a way for them to gain more tax revenue at the federal level, at the state level, at the local level, just like you rightly pointed out.
Yep, stagflate, tax lie, and the government and central banks have benefited heavily from asset price inflation. I would argue that quantitative easing, one of the main purposes for it is not what the Federal Reserve says for jobs and some of the other mandates that the Fed has, that one of the main reasons was to inflate asset prices. And so the government could tax stocks, bonds, and real estate more.
Yeah. Oh, you're absolutely right. And, not to mention the Cantillon effect. You've talked about that before. I've heard you talking about it. And,
oh, yeah.
And all
it drives
the elites,
everything. Mm-hmm.
Yeah. All the elites are closest to the money. So they're going to benefit first, and they're going to leave us with the scraps. Yeah, it's a real scam, no question about it.
Well, I really enjoyed our discussion today about real estate, Jason. If my listeners want to listen to your podcast or take a look at your real estate investors education, how do they do so?
Yeah, thanks for having me on, Jason. It's always great to talk to you. You're just so well informed about this stuff. I just love talking with you about it and listening to your show. My main website is just my name. It's jasonhartman.com. And my podcast can be found on any podcast platform, The Creating Wealth Show. And I have some other podcasts as well that might be of interest. Just type my name into your podcast platform. And I'm also on YouTube. The Thought Police allow me to speak, and they haven't gotten rid of me yet. So let's hope they don't, and we'll keep getting the word out.
It's very interesting what's going on in real estate. We'll see what the Fed decides to do, but at some point they're not going to be able to keep raising rates, although the mortgage interest rates are already pricing in more Fed rate hikes. So it's already affected the market like you detailed earlier in the interview.
Yeah, it sure has. We'll see what happens. Really, as far as the real estate market, I'll say what the weatherman says. TETT, too early to tell. We're just in the beginning stages. We are seeing inventory bump up a bit, but this next 2 months is going to be kind of critical. I'll be reporting on it, on every episode I do. And, it's a real critical time to watch things. But right now, I would say we are very far away from any kind of bubble popping. Okay. There will be a correction at some point, no doubt. But it's a ways away. From what I can see.